And we're
Okay.
recording.
Yeah, and I didn't forget to unpause the recording, so I think we're good.
Yeah.
Okay.
So we are doing the virtual home buyer seminar with Eric Miller of Fianance of America. He's here to talk to you about the home buying process with everything going on, what you should be doing now if you're a little ways out, what's going on with interest rates, some of the changes that are happening. So Eric, we'll let you take it away.
All right. Well, for your attention, and Carrie and Sharice, thanks so much for having me. Can you guys hear me okay?
Yep.
Yeah.
Cool. So obviously there is a lot going on in the world these days, and it's still a great time to buy, especially with rates being low. And we'll talk about interest rates and such as the time goes. As far as buyers in the marketplace, typically fall into a couple categories. First-time buyers, people through the process, have never owned a home before, tend to have different concerns or challenges than people move-up buyers to buy a bigger house, or move down buyers selling to buy a smaller house, and they have different concerns. And you're looking to get into the market and purchase, understand that qualification criteria basically amounts to three things. We evaluate your credit history, we evaluate your income, and we evaluate your assets. That's money that you have available for down payment, closing costs, etc. Right? That standard is universal, whether a first buyer or a move-up buyer or buying the property or what have you, and different programs geared or tailored toward different criteria. So if you have a bigger down payment and better credit scores, you qualify for a loan than if you have more down payment, but in either and qualify for a really good year fixed loan rate. And that will give you the opportunity to obviously purchase your dream home, or at least your first home. My job as a mortgage advisor is to help borrowers understand what their parameters are, figure out what your goals are, and how you can meet that by qualifying for a purchase, whether that's a house or condo or whatever that may be. And as far as what's out there today, obviously things are crazy right now with the pandemic that we have, the COVID-19, and it has created some heartburn for all industries. As it relates to mortgage and qualifying, you could still get a loan. It's still possible to buy houses. And in fact, there still are deals available, and rates are getting really, really good right now. So it is a good time to be in the market. I think where it looks like what's going to happen is, obviously employment is going to be a big concern in the current environment in terms of verifying that people are still working. So a lot of companies have temporarily closed or have furloughed workers, and that's a big question for qualifying for a loan. You have to show that you can repay the loan, so you have to be able to demonstrate employment. That's going to be a big test. So that's my first go at it. Carrie, Sharice, let me know if you have any specific questions that you'd like me to address. I'm certainly happy to take questions from anybody.
So I think a lot of people are in the mind frame that they're going to wait 2 to 3, maybe even 6 months. Or have they put out what they're forecasting interest rates to be in 2 or 3 months, 6 months down the road? Are they thinking they're going to stay kind of where they are right now, or?
Great question. Great question. I understand people who are thinking that they want to sit this out until things stabilize or get better. I think in particular, people whose jobs are in jeopardy or aren't working or are in between or uncertain, that makes sense. Interest rates on the whole are getting really, really good. When I say good, I'm saying near historic lows, which means that people's affordability is going to be high. My best guess is that rates will get low and continue to stay low for the foreseeable future. So for several months, we're going to have an opportunity at low rates. I think that the risk that people will have is, depending on how long this shelter in place order stays in effect, and depending on how companies are able to respond to it, is how it affects people's ability to earn income. So if you have employment now and you have stability in the next 3 months, it's not a terrible idea to consider your options. If it doesn't make sense, then certainly wait. The risk would be if we're sheltering in place for 6 months, what happens to the job market? What happens to people's ability to earn income? And that could effectively prevent you from qualifying and prevent you from wanting to buy in the first place. Those things are really hard to predict. It seems to me that I think we're going to have a real good opportunity with interest rates for the time being, for the next 6 months, 3 months. So depending on when you're ready, we'll be right.
Okay. So let's say there is uncertainty with their job. What can they be doing right now? Should they be talking to you now, maybe to see if they have issues with their credit that they can fix in the meantime, or if they're getting money from a family member, or is there anything they can be doing right now to prep themselves?
Sure. Well, it never hurts to prepare early, especially since qualifying involves analysis of your credit history and how you earn income. If the way things are affecting our industry with respect to the COVID-19 is guidelines are getting a little bit tighter, and there are new sort of guidelines being implemented on a lot of traditional standard programs to help people qualify, which means that we're looking for only the people that are most likely to repay their debt, right? So what that would look like for a borrower would be, whereas 2 weeks ago, a borrower with a 580 FICO score could buy a house with 3.5% down and have no money in the bank. Now, our company at least would require that borrower have at least a 620 FICO score. And if they have a 620 FICO score, they might also need extra money in reserve, meaning money in the bank that they don't bring to pay for the house, to show that they have extra months payments in reserve in the event that they are furloughed or lose their job, that kind of thing. So I think having a conversation with a mortgage advisor, a seasoned person who understands what's going on, is always a good idea, because it doesn't require any financial commitment, one. And two, you can really help yourself understand what things you need to work toward, even if you're 6 months out. It doesn't cost you much to spend 10 or 15 minutes on the phone with somebody, walk them through kind of what you want to do, what you have to offer, and to get some advice or consult about what you should do to prepare yourself for when the time is right.
And I think that's important for people to understand, that it could be as little as a 10 to 15 minute conversation with you to really assess their situation and know exactly what to do. Because I think people get intimidated by it and think it's going to be some long drawn out process. And then the initial doesn't need to be anything like that.
Yeah, I try with my initial consultation to keep it to 15 minutes. Certainly some borrowers want to know more or maybe farther into the process. And so they might have more specific questions or want to know why things are the way they are. But for the most part, the first call is to introduce myself, assess kind of what they want to do, what their time frame is, and just give them some basics. Here's the 3 things we have to concern ourselves with. How do you fit within this criteria? And then from there, I usually would be able to follow up with, okay, your next step would be, if you want to move forward to the next rung on the ladder, it's you fill out an application, give me the following items, and then we can really see what you're eligible for and what the terms might be. Yeah. But that doesn't all have to happen on the first call. In fact, it's usually too much information to really distill down in one call anyway. So it's always good to have that first call.
Yeah. And generally, what are the documents that you're looking to collect from them once they are ready to fill out an application and go through that process?
Well, the application is primary. That basically is, your personal biographical info, name, date of birth, social security number, so we can pull credit, your work history. So to be eligible for a loan, you've got to be in the workforce for at least 2 years. Doesn't mean at the same job, but you do have to show that you've been working. And for the record, education, meaning higher education, college, can count toward that 2-year requirement, particularly if you were studying in a field that you now pursue as a profession. So if you were in nursing school and now you're a nurse and you've been working for 6 months, first of all, God bless you. And then secondly,
definitely,
we can use your nursing history as criteria to help you qualify because you were working in your vocation. It just you weren't getting paid for it. Okay.
Interesting.
I didn't know that.
Now, as far as documentation goes, we typically need 2 years of filed tax information. So that could mean W-2s if you're an employee. It could also mean actual tax returns if you're self-employed. Like if you're a real estate agent and you're an independent contractor, you file your income on a different tax schedule on your tax returns. We need to see that to verify what kind of income you make. A lot of it is dependent on how you earn your income. So if I'm a salaried employee, W-2s and pay stubs are adequate in almost every case. If I am a commissioned salesperson, then I can still probably get away with W-2s if I'm an employee. Whereas if I'm an independent contractor, like a realtor or an insurance agent or someone like that, I might have to provide tax returns to see what expenses you consider against your income, which would affect your ability to qualify. Okay. As far as other documentation, assets, I have to show any money used toward the purchase for a period of 60 days total prior to the close of escrow. So typically in a pre-qual consultation, I'm just looking at, okay, how much money do we have available to work with? How much do you feel comfortable spending or using toward a purchase? And where is that money going to come from? Right? So if you have your money in your savings account, it's pretty simple. I just need to see a savings account. I would set your file up with that account information in there, and then we can always update the account information as we get closer to purchase. But a lot of folks have more sophisticated profile, meaning, okay, I've got some money in this account and my mom's going to gift me some money, and I've also got, some money in the mattress that I want to use toward the purchase, but I don't trust banks, so I don't put it there. And those things it can be challenging because there are certain rules that we are given as far as proving that the money used is legal money, right? We're looking for proof that the money is legitimate and not coming from somebody who's not connected to the purchase. So that requires to provide evidence of all the funds, right? And that's basically it. Application, credit report, proof of income, and proof of assets. And a lot of that information will expire over time, like your pay stubs, okay? And we can just refresh them and get new ones as we go. So if you were starting now and decided not to buy for 6 months, it's still fine to work on getting your file organized. And the benefit really is that you can identify things that maybe you need to work on or improve to get yourself ready so that you have the opportunity to buy the house you want to buy when the time is right, when you're ready to go.
Like if you have cash, you could deposit that now and it could sit in the account long enough that.
Right. So the requirement for assets is that I show the money in your possession for 60 days, and that's 60 days prior to the close of escrow. So if you have money in your account that you want to put into your account that's sitting in your safe, for example, and you were to deposit it in the bank, I can't prove that money is yours because it came in the form of cash. But if the money is in your account for 2 months before I see a bank statement, I wouldn't know necessarily that you deposited it there, right? That's an important distinction, especially with first-time buyers, where we see a lot of folks where they have family members who want to come out of the woodwork to help. They want to come from the sideline and say, hey, my uncle gave me an extra $5,000 in cash and I just put it in my bank account. Love it. It's a wonderful gesture, but it can complicate the process if you're under contract and I have to prove that the money came from your uncle and not from some other source who shouldn't be able to give you money, if that makes sense.
Yeah, absolutely. I think that's it.
We're good.
Anything else, Eric, that you want to share?
Well, a couple things to keep in mind if you weren't already aware. One, the IRS did extend the tax filing deadline for 2019 taxes to July 17th as opposed to April. So if you were planning on filing or you were thinking of filing, you have a little bit more time to worry about that. That really affects self-employed borrowers more because self-employed borrowers typically have to show tax returns to qualify. And that might impact their ability to, qualify for more or less. There are a lot of changes in our industry coming across as, things contract with respect to qualifying guidelines. So just make sure that you're working with somebody who understands the market, who understands what's going on and knows what questions to ask so that you set yourself up for the best possible outcome. That's what I'd say.
Got it.
Awesome.
Thank you.
Can you see our screen share?
I can. Yes.
Okay. So this is Eric's contact information. If you have any questions, he is happy to help.
I am. Thank you so much for your time and opportunity.
Okay. Thank you for joining us.
Yep.
Thanks, Eric.
Have a good one.
You too. Bye. Okay, so we are now going to go into the actual home buying process. So 3 things you didn't know about buying a home. You can still purchase a home right now. Viewing homes online obviously is pretty simple. Our website is herecaliberre.net. There are a couple of different ways you can get to the property. So here, if you just put in an area, let's say you want to live in Anaheim Hills, you can just put the general information in right here, and then you click on search homes. On our website, it gives you the ability to set up a virtual showing. So let's just say you could, from this spot here, you can then go on to change the what you're looking for. You can put in bedroom, bathrooms, property types, if you're looking for a pool, whatnot. But if you click on the properties, click on full details, right here, it'll say schedule a tour. You can schedule an in-person tour or you can do a video chat tour. So we are still doing in-person showings, but those are reserved for people who are really ready to buy right now. Obviously, we want to keep people as safe as possible. So if you're 6 months out, 3 months out, doing an in-person showing right now is probably not the best. But if you have to do one, where the rules are stating that you can't have more than 2 decision makers present, along with a real estate agent. And then they're asking that you not touch anything in the home. We wear booties. Everything will be open for you, blinds, closets, so you can see everything. They're just asking that you don't touch anything while you're in the property. The other option would be a video chat tour where we're either getting on FaceTime or Google Hangouts and we're walking you through the property. Some of the homes already have videos shot, or they have a Matterport tour, things along those lines. So you can still view homes right now. It's just a little bit of a different manner. A lot. So what should you be doing right now? What can you do if you're, let's say, 2 to 3 months out? I would say get in your car and drive around to neighborhoods. See how far it is from your favorite Starbucks. See how far it is to your kids' school, to work, all of that stuff. So you can still be doing those things right now.
Or you're ruling out neighborhoods, ruling in favorite streets, writing down notes as far as what do you like, what don't you like, what is like a deal breaker, what are your like quadrants where you want to be, so that when they do start to pop back up, that you're ready.
And I think everybody is at home right now, so it'll give you a good idea of
the density. When everyone's home, can you still park?
Right. Exactly. We kind of already went over these. So another thing that you may not realize is that the buyer market will likely remain competitive. Eric kind of talked about interest rates staying relatively low over the next few months. So depending on your price point, you're going to need to prepare maybe a letter. Once you are ready to put offers in, we recommend to our buyers that you write a letter with a family photo. We even had one client shoot a video with their kid.
And we were the winner.
And we got the offer accepted. So it's things like that that'll help when everything gets back to normal, to give you that competitive advantage. Having a pre-approval letter from a good lender like Eric is definitely going to help. Having all of your finances together clean definitely will help. Having an offer that's written super clean and will help you with that is very helpful. But that personal touch means a lot, especially if the seller has been in the home for 20 years.
But as long as interest rates stay low, that market will remain, buyer market will probably most likely remain competitive.
And then third, that you may not know, is that our first services are free to home buyers. You don't pay us anything. The seller pays our fee. So why not use a professional who can help you navigate through searching for a home, getting your offer accepted, negotiations once you're in escrow, all of that stuff. So those are the 3 that we wanted to go over that you may not have known. Now, everybody has questions about what's going on in the real estate market because of the pandemic. So we'll go over these. I have slides for most of them, but the main thing is that this is not 2008, where the housing market caused the crash. Everybody had loans that they shouldn't have had in the first place. People were using their homes as ATMs, pulling out money to buy cars, to buy jeans, to buy dinner. Like, it was crazy. So that's not this case right now. The stock market crash, we'll talk about that and how that's affecting things. Is there going to be a huge wave of foreclosures? And then we'll talk about the recovery. So here's a slide on what happened 2008-ish, where the housing market tanked, right? It dropped 51% I'm sorry, this is the S&P 500, dropped 51%. And you can see that housing prices depreciated over those 3 years. What the experts are saying that what we're experiencing right now is more similar to the .com and 9/11 crash, where the S&P 500 took a huge hit, but we actually saw appreciation in home prices during that time. And this was because this crash in the stock market was not caused by the housing market, where in 2007-8, it was definitely caused by the housing market. So that's the big difference. So the experts are saying that they don't think housing prices are going to take a huge hit like they did. And here's another reason why, is that you can see in 2000 through 2005 to 2007, $824 billion of equity was pulled out of people's homes.
That's a lot of genes.
And now this is only through the first 3 quarters of 2019, but still it's only at $232 billion. That's a huge difference. So this is why they're saying that they don't foresee a huge uptick in foreclosures, because over 50% of homeowners have at least 50% equity. So the people who are out of jobs, there's a good chance that they can sell right now and not have to go through the short sale or foreclosure process. So I think that is the biggest difference between 2008 and what we're going through right now. This was a stat. This one's a little bit old, from March 24th, and it's crazy how quickly things are changing. So the experts are predicting that this quarter is going to be rough, obviously, but they're saying that the uptick into quarter 3 is going to happen very quickly. So here is a more recent slide, just a few days ago, and it breaks down what the different experts are saying at Goldman Sachs, Morgan Stanley, JP Morgan, but they're all expecting this V-type recovery, where after we hit the bottom in quarter 2, we're going to recover.
Everyone's going to go out to dinner.
Right, everyone's going to go out to dinner. Everybody's going to go to the movies. They're going to go on vacation. So it's whether you're in a position to buy right now or it's 6 months, the experts are saying they don't foresee a huge crash in the housing market. So that's kind of the message that we wanted to provide for you. The best would be to schedule a one-on-one consultation with us. We can come up with a game plan. If you are 2 or 3 months out, 6 months, even a year out, we can come up with a game plan for you that will help when you are ready to purchase. We'll go over what you can do now to prep, and Eric kind of went over a lot of that, but you can go onto this Calendly link and we'll post it for you, obviously, or you can just give us a call and we'll be happy to schedule. It's free, no strings. So let us know if you have any questions. We're here to help. Thanks for watching.
Need anything else, so we can deliver anything to you, you just let us know. Thanks.
Bye.